There's a couple different ways to use them. A lot of traders use them to try and trade in between, buy when it hits the lower band, sell when it hits the higher band. That's one way to use them. Another way
Welcome back, traders and investors. We have Todd Schoenberger on the line, and he is president of Streicher Asset Management. He's been in the business for a long time and has been through up and down markets. Todd, how you doing today?
I'm doing fantastic, Joel. How are you doing?
You're doing good because the S&Ps are trading up 13 points, and you were out there buying the last couple days.
That's right. You got that right, because here you have a stock market that if you look at the intraday high all the way going into today's action, the Dow has been down 3.9%. If you wanted a great entry point, a great buying opportunity, that was it, because obviously today's going to be a monster day in the markets.
Okay, so were you anticipating that sell-off at all a little bit? We made new all-time highs, hung up there around 2,000 for quite a while. Were you able to take anything off up there and redeploy your cash, or did you just stay in through thick and thin?
Well, look, here's the stock market. What I'm thinking is that there isn't that one catalyst, that one reason that's going to break the back of the bulls and really start a correction pattern. If you look at just the last 3 years, you have a stock market that has literally not dropped 10% to give us that typical correction period. And so if you're looking for that catalyst, we just haven't had it. So here you have this market that continues to rally, continues to do what it's supposed to do, and even with this sell-off right now, I mean, you could pick and choose your spots, but realistically, I mean, if you want to, all you got to do is look at the headlines, Joel. You know to stay away from travel and leisure. You know to stay away from the airlines right now because of what's going on in Dallas. But yet you look at some of these big cap, large cap companies, even the multinationals, they continue to do well, and therefore, if you're looking to deploy cash, that's the place to go.
So what do you do with these kind of headlines and stuff? Do you just try and block them out? I mean, it has had a big effect on the market. Do you just have your game plan and you stick to it, or what do you do with these kind of headlines?
That's right. So you have to obviously keep one eye on the stock market. We continue to talk about things like years ago, 100 years ago, you had the ticker tape. Now we have what we call as the Twitter tape. So this market is headline driven. So here you had a couple of things. We hear the IMF is going to lower their forecast for global growth, and you're hearing about a potential slowdown in Europe and possible recessionary territory that they may be entering. And then you obviously have the Ebola issue. So there's a number of headlines out there that are. And so it causes a great panic, causes a reason to sell off. But if you take a step back and look at the macro picture right now, the stock market continues to move higher. And the reason why is case in point today. Here you have a jobs number that did well. Now, granted, if you look behind the curtain, the numbers aren't that sensational. But regardless, you have a stock market that continues to move higher only because earnings are continuing to look solid. We can only anticipate a very robust holiday shopping season. And if that's the case, I mean, I'm thinking the sky's the limit for this market. Plus, don't forget, everybody's betting that you're going to have a change in monetary policy. We haven't seen any hint that anything's going to happen the rest of this year. It's probably going to happen in 2015, as we've been told. And so as a result, it would be a great time to take advantage of these selling periods and move into the markets.
You mentioned, that was a good saying, the ticker tape, the Twitter tape. Do you are you on Twitter? Do you pay attention to Twitter? Is that something that you have up on your screen, or do you just try and filter all that out?
I do, and the reason why I am is that because you have a number of people, a number of I would say fund managers, some real notable people that would actually they're on Twitter and they like to tell the world what's going on. There's nothing wrong with that. There's absolutely nothing wrong with that. With that said, though, you have the markets will move on what people talk about. So if Carl Icahn is on Twitter and he makes a comment, it immediately moves markets. If Tepper goes on CNBC, the same exact situation happens. So when I see that, it's best to really know what's happening with Twitter. Am I going on there? I mean, I go on there probably more to sensationalize than anything, but it's more as a funny pattern of what I'm trying to do. But the point is that for investors, they need to know what's going on with the headlines. If they don't understand what's going on with headline news, then they're going to have problems. And because this market will move based on what takes place in the headlines, and so it's best to just to stay focused on what's going on in the news, because it's obvious that's going to impact the markets.
Okay, and over the last couple of days, you said that you were looking at some opportunities there. Do you have any issues that you'd like to share with us?
Well, look, for investors, if you're looking for some key points of interest, areas that you clearly want to stay away from. Travel and leisure right now is it's the worst sector to be in right now because of what's going on with Ebola. So we know that. Best to stay away. However, if you really want to start focusing on the next 3 months, keep an eye on items such as retailers. And I know this sounds crazy, but when you start hearing headline news about a lot of these key retailers hiring, you're expecting 10 to 15% more seasonal hires this year for the holiday shopping season. We just completed a very healthy back-to-school shopping season, which has historically meant a great back-to-school shopping, which usually equates to a great holiday shopping season, which will be great for retailers. I think that the numbers that we saw today, the reason why the stock market is higher today, and normally you would think good news will be bad news, but the reason why is because you can only expect you're going to have investors, more people are going to be shopping, and therefore that's going to help investors because you're going to obviously have higher earnings. So when you start, traders are going to look at the next 3 months. They're not going to look backwards. They're going to look forwards. And you can only suspect that the hottest sector out there that's going to have some solid gains actually for the final quarter is probably going to be in the retail market. I know it sounds crazy, but the reason why it's crazy is because it will probably work for you.
Could you share a few names with us? Do you like to go with the big box ones, the Walmarts, the Costco's, or you looking at J.C. Penney or something like that? I mean, J.C. Penney. Are you looking at something like that?
I'm not a fan of the J.C. Penney's of the world, but definitely look at Kohl's, look at Walmart, Costco, Target. Those should do well this season, and don't discount. And I don't discount these Family Dollar stores. There was obviously with the M&A activity, they've been all over the place, been very volatile, but definitely not a group you want to stay away from right now. Only because, despite the fact that if you really want to look behind it, the numbers today that we saw in the job market, average hourly earnings just remain stagnant. They didn't move at all, so people are still going to penny pinch. And therefore, they're going to look for the discounts. Obviously, the dollar store should do well, as including with that prognosis.
So you like some of the dollar stores, huh? What has been going on with that? We haven't heard much about that Dollar General, Dollar Tree, that thing going on lately. Is that when stocks start to get into that kind of merger thing, do you kind of just take them off the radar and let things shake out, or do you try and play the rumor and innuendo surrounding those kind of things?
That's what traders are going to focus on. So what we talked about before, Joel, we talked about this the last time I was on the show, is about potential merger and acquisition activity and why it's important right now, because you have this feeling that if interest rates start to move higher and you're going to have a change in monetary policy, is the result of that going to be higher inflationary concerns? Where I'm going with this is that you're going to have companies that will actually acquire another company, not so much for the market share, for the increase in market share. They're going to do it because they need an increase in revenue. They need that increase in revenue stream, and therefore they need to do that because it's of an inflationary environment. You're going to see a lot more M&A activity. We actually have seen, for example, in the oil industry, this year alone, we are actually up 50% in merger and acquisition activity from this time last year. And you have deals equating, just billions of dollars in deals that have taken place so far in oil. And a big reason why is because now, like we see WTI is rolling over right now. That's all fine and good, but regardless, you have oil companies that need to show its continued revenue strength, for continued revenue growth. You see that in those dollar stores and those deals. You're going to continue to see that for the rest of the year. And don't be alarmed. I mean, I wouldn't say alarmed, but don't be surprised if the next few Mondays, Monday mornings in October, people are waking up, investors are waking up hearing about some blockbuster M&A news. And the reason for that, if you really want to get down into it, it's look at the cash flow numbers. And the company that's acquiring the other company, that's what they're focused on. They're not worried about the products or market share. They're looking at that cash flow right now.
What about all the IPOs that are? Just seems like we've had quite a few of those. Does that make you a little bit worried? Something symptomatic of a long-term market top? I know Mark Hulbert, wrote an article the same day that Alibaba IPO'd. The market made the all-time high. That was also a quad witch. Is that something that that makes you a little bit nervous about the market?
Well, historically, you would think it would, because you're always going to have that. Well, why would this company go public or that company go public? But and it is a deep reflection of the stock market. I mean, the stocks are up, and if the markets are rising, it's a great time to go public, because it makes to be blunt, it makes investment bankers' lives easier, and so because they can value a company, they go to market, they go public. And if you have a pop, an immediate pop, Alibaba as an example, that looks great. Looks great for the bankers. Looks great for whomever came up with the valuation. I mean, it looks wonderful. So with that, you want you're going to see more of that, and you'll continue to see more of that as companies try to raise funding. You have a number of look who a lot of these investors are with a lot of these deals. A lot of PE firms, venture capitalists. There's always going to be an exit strategy. And if you look back over the last few years, if you go back to, say, 2010, when there was a feeling that, okay, we are coming out of this economic implosion, worldwide implosion, and even 2011, there were some VCs that were actually committing dollars that obviously banks were not doing, and they probably still don't. So a lot of these venture capitalists are thinking, okay, I got a 3 to 5 year exit strategy. I have to have that window, meaning that the company either is sold, that they're investing in, or is going public. And this right now is a result of that. Companies like a GoPro, even Alibaba, and you have companies that were receiving investment dollars a few years ago after the economic implosion, and this is just their process. This is the time for them to exit out, and that's what you're seeing right now.
I can't figure out this Yahoo. I mean, if you take the implied value from their stake in Alibaba, I mean, it seems like it's almost the value of the entire company. What? I mean, is Yahoo something you're interested in? You think that there's some potential value in it, or what is the street seeing that I'm not seeing?
I love Yahoo, and here's why. Yahoo is actually, and I know it sounds crazy, but they are a category killer when it comes to multimedia. And where I'm going with that is with their own web, with their own site. They have chapters such as Yahoo Finance or Yahoo Television. And what you're seeing now in the world, especially here in the United States, is this ability to watch television from a single device, such as an iPad or a tablet, iPhone, whatever it is. Not a lot of people are buying televisions anymore. They don't sit around watching TV, or if they do, they're probably doing something such as looking, going on Facebook or whatever they're doing on TV. My point is this, is that if you look at a company that's investing so much money into multimedia, it's Yahoo. And what you're not going to really see the true result of Yahoo probably for another 2 to 3 years. And the reason being is that as this migration occurs where everybody moves further into using devices and watching content, watching video through multimedia sites and getting away from the network television of sorts. Everybody's focused on Netflix, for example. You're going to have Yahoo is going to be a true winner there. So, but it's going to take time. And Marissa Meyer, she's been very vocal about this. And internally, this is their mandate: to focus and spend money on the multimedia side, because they know that more video, more content equates to more ad dollars. But again, you're probably not going to see that for a couple more years. But investors will be best served to consider Yahoo, because, in my opinion, that's going to be one of the true tech winners in the next handful of years for investors.
Okay, and what about Baba?
Well, Alibaba, I mean, look, once I saw Alibaba cross 90, I thought, oh my goodness, you cannot get into this thing, and there was so much hoopla about it. The thing about it, Joel, is that I think the Alibaba, even Twitter IPO, if you really think about companies that have it's not just about a company going public anymore. It's the marketability of the story, and you have the idea that they're on TV. It's the cover story on USA Today, and when you hear you don't just tell the story. You have to sell the story, and the Alibaba story is a good story. Jack Ma, very good, rags to riches type of story. But I guarantee, if you ask your common investor, do they know what they're investing in? They probably don't even know what they're investing in. They're just buying the headline. So I think that the end result for a company like that, especially the transparency part of it, because they're based in China and you have to question numbers, you always do, unless they're in the United States. I think investors, the risk is just way too high to go into an Alibaba. The stock plummets 25% and really comes to a decent valuation, then it would be a viable opportunity. But right now, I'd stay away from it.
Okay, all right, and just final thoughts here on the market. I know you've been pretty bullish with your stance here. Is there something, as far as a technical level or something like that would shake you, from that stance?
No, if you're looking at any type of a correction period, here, if you had a stock market that continued to test lower lows, then that would make sense. But you're not seeing that at all. There's no justification out there. You can look at the technical level if you want. S&P 1950 is obviously a psychological number, but realistically, this stock market's going to continue to hit higher highs, and it's going to continue to do this in the fourth quarter of this year. There isn't anything out there. The only thing that really is out there, obviously, is I personally think this Ebola issue. If you hear more cases, more patients here in the U.S., that can be highly impactful. But that's a story that will occur the next time I come on your show. The other side of it is obviously the hostile conflicts that are taking place around the globe. Again, though, the United States, we don't engage in fist fights with the enemy anymore. And so dropping bombs from airplanes is fine, but the action is over there. I'm not trying to minimalize or say that it's not relevant, because it is. It clearly is. But when you look at what happens here in the homeland, the United States still is the number one country to invest in, and also offers the best transparency. And so when you have that, this is the best place to invest. So final thoughts for your listeners. Clearly, this stock market is going to keep moving higher. Continue to keep one eyeball on the headline news, because that is always going to be a potential risk. But there isn't anything out there right now that's going to signal that stocks are going to be selling off anytime soon.
Okay, Todd Schoenberger, president of J. Streicher Asset Management, sticking with his bullish thesis here on the market. Todd, thanks for coming on today, and we hope to speak to you again soon.
Sounds good, Joel. You take care now.
Okay.